fellow investors. Welcome to another episode of Ritter On Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Mark Cira, and Mark is the co-founder of Cira Capital Group, a firm focused on curating diverse private real estate investments. And Mark, thank you so much for being on the show today.
Thanks a lot, Kent. Really happy to be here.
Yeah, well, I'm looking forward to getting your perspective. You got a pretty unique background. We've got some similarities in our backgrounds, so I think that'll be fun to talk about. So let's start there. Before we dig into it, tell people a little bit more about who you are and how you got to where you are today.
Sure. Well, I'll kind of go all the way back to, the beginning. I graduated from Iowa State University with an accounting degree, studied some engineering in there, but ultimately went to get my CPA and did some management consulting right out of the gate, right out of college. Worked for like Navigant Consulting and Ernst & Young, a couple places like that, but ultimately went on my own around 2010 and started working for one of my clients actually along the way. And as that company began to grow, the founder brought me on eventually as their CFO. And so today I'm the CFO of that, what was once a client, but is now, part of my portfolio. I'm an owner in the company and, do the day-to-day type CFO stuff. So, became a busy professional that way. And along the way, I discovered real estate as well through my wife, actually, here in Chicago. Around the same time that I went out on my own as a consultant, I met my wife, who is a general contractor here in Chicago, and she introduced me to real estate as an option for investing. We were going to build our own house, and we bought some land. We eventually ended up turning that land into an investment properties and selling them instead of building our own house. Long story there, but it turned out to be kind of a light bulb moment for me because I really thought before that real estate was just for rich people, and it really wasn't an investment that somebody like myself could get involved in. So when that happened, I really started to dig into what the options were. And we spent a lot of time doing, development. We still do some of that here in Chicago with her family business. But we also got into mobile home parks. We got into syndications, passive investing. And what I realized through that from around 2016 on, especially as my career started taking off and I got busier with my CFO role, I realized that passive investing for me was really the right answer. And it really is the right answer for a lot of professionals because as you get busier in syndications, you're really taking on your own job. And so that's how I came around to starting Cira Capital Group in order to provide a way to passively invest in operators that have been around for a long time, providing a foundational investment for busy professionals like myself. So that's how we came around, and that's what we're doing today.
Gotcha. I gotcha. So you're still full time. You're working as your CFO, and you've identified a way to essentially act as a fund of funds and kind of pool investment money together. Is that right?
That's right. Yeah, we've developed a lot of relationships over the last 5, 6, 7 years in passive investments. We've watched a lot of track records of investors, and we think that we've identified a number that we think have very long-term staying power, that are have deep connections and roots in their markets. Many of them have been around for 20, 30 years, and those are the types of investments I think are great for busy professionals that are looking for some exposure to private equity, especially real estate like this. And diversifying from their 401ks or their traditional investments into something that's more like what the institutions do. So allocating a little bit of their income or a little bit of their nest egg from the traditional investments over to some private equity.
Yeah. Well, I think that's great. I mean, I think the more people that you can get investing in real estate in a safe way is going to benefit them and going to benefit everyone. I'm a huge proponent of diversifying into real estate, at least having a portion of your portfolio allocated. Like you said, you mentioned the institutions a couple of times. I mean, if you look at the biggest endowments or the richest people in the world, they all have an allocation into real estate, right?
That's right.
And we often wonder why as individuals it's not so common. And I think a lot of
Exactly.
that is access. It's just access. Access has become a lot better in the past, I don't know, 6 years. When I first started, there wasn't much. It's expanded much more. I think it's much more commonplace, but still, it's difficult to find really solid operators. Right? There's a lot of people out there raising money with varying levels of experience. It sounds like you guys have kind of gone to the extreme, finding 20, 30-year veterans. Um, and what type of asset classes are you investing in?
So multifamily, of course, that's a very foundational asset for, almost everybody in real estate is multifamily. Self-storage is another, and mobile home parks or manufactured housing is another that, it's been hot over the last couple of years, but it does have very attractive returns still, as well as a market that, is kind of protected. It's not going away. There's a lot of demand for it. And so it does have some aspects of a very good long-term investment. And there's ways that improving those properties, many have been owned by mom and pops for a long time, small and consolidating portfolios does have benefits for both residents today as well as investors. So I think there's a kind of a win-win there. And it's been a neglected area for, at least the last 20, 30 years, I think. And some of this investment is really helping that area. So those are the three prime areas. We are looking today at trying to get into some more industrial, because that is an area that I see continuing to be, expanding and attractive as we move more towards, the Amazons and all of the deliveries. Much more of that last mile and the infrastructure around warehousing is going to be important. And I believe that's going to continue as we see more moving towards, e-shopping, on the internet and that sort of thing, deliveries. So that's a very small part of the logistic network right now, but I believe that's going to be continuing to increase. So we're looking at industrial as well.
Sure.
Office space, that's a question mark these days. Not really sure which way that's going to go at this point. But it could be one of those things that now's a great time to invest in office space. If you go to the right markets where maybe there's some depressed, cap rates, or not depressed cap rates, depressed valuations, higher cap rates due to, uncertainty around that market or whatever. But, we're not actively seeking office unless there's a great opportunity that's just screaming at us.
Sure. Yeah. No, a lot of risks there still, a lot of uncertainty. So just getting back to thinking about real estate, you got involved, and you're obviously a large proponent of it now. You've created this fund. But what is it that, beyond the diversification, I guess, which we understand the need to diversify and not have all our eggs in one basket. What else is it about real estate that has made you such a big proponent?
Well, I think it's kind of a natural bridge between, your traditional bond investing, which is paying zero right now, and equities, right? It has a component of both, because you have sort of an equity appreciation aspect to real estate as the asset, grows in value over time while you hold it, but it also produces dividend-like returns through, the rental income and distributions that the real estate delivers. So you've kind of got this like mixed investment that's doing a little bit of both of those things. So it's kind of a natural bridge in a portfolio. And that's one of the reasons I really like real estate. Besides the fact that so many people own it, it's a foundational kind of investment. And they're not making more land, and they're not, you can build new things on the land, but it's sort of always going to be there, right?
Yeah, there's definitely limited supply, right? And
Right.
I think that varies, kind of where you are, but overall, yeah, we're not making any more of it. I think that's a good point. And I think that, yeah, from a return standpoint, I think it can, I think it is a good bridge. I think that goes back to diversification. I think oftentimes though, the returns can even be better than what you're seeing in either of those other asset classes. So I
Oh,
think on
absolutely.
the return
Yeah.
upside, it's also can have a lot of qualities. I think when we look at things on a risk adjusted return standpoint, right? There's um, real estate has historically stood out because of the limited downside risk, depending on the type of investment you're making. Not all investments are the same, but the ability for appreciation that can typically outpace, what you've seen on the equity markets.
Absolutely. Yeah. And there are comparisons out there. You can do Google searches and, find all kinds of reports of, comparing real estate or private equity to the stock market. And it typically has better returns with less volatility, less risk, right? So that's another reason why it fits so well with a portfolio, I believe. You've got
Yeah.
a risky end of maybe, stocks, and you've got a very, very safe end of bonds, and somewhere in there is real estate.
Yeah. Gotcha. So what is it? We talked a little bit about how real estate investing has become so much more the norm, right? We're seeing a ton of people get into real estate investing. What do you think is driving all this interest within real estate?
Well, I think a number of things. First, obviously the returns, and people see that and they're interested in it, especially as the lower end, of their portfolio, the bonds and the safe part of it is not paying anything. So you've got to go up the risk spectrum, right, to find yield and return. So much more people are seeking exposure to those assets that are producing cash flow or returns, and real estate is one of those. So that's a big thing. Access to capital. We've seen a flood of spending and borrowing from the federal government that's out there. People have a lot more cash in their pockets these days to invest. So I think that is driving a lot of interest in, hey, what else is out there? Their feeling of, maybe the stock market's overvalued. So what else can we go look at, and how can we find safety in our investments, and where can we put it that's not in the bank account or under the mattress, earning zero or negative at this point with inflation being high at this point. So I think there's a number of things driving the interest, and those are sort of the big key factors.
Yeah, and I think those all make total sense. I think we're seeing that in kind of a little bit of a microcosm over the past just a few months, right? As you see, we see inflation, we see all kind of economic uncertainty, we see interest rates starting to move because of all that. How do you see all these new factors playing into, what's happening now, and then what are you projecting over the next, however far your crystal ball goes out?
Yeah, it doesn't go out very far these days with, conflict in Europe and, uncertainty about inflation and how long it's going to last, whether the word transitory was sort of the word of 2021, but we're seeing whether that's actually the case, and that it's being tested with, a lot of this uncertainty coming out of the politics and the war. So I think we're back to an area of extreme uncertainty, which drives me back towards diversification is very important when you have very little, crystal ball, as you said, that doesn't go out very far. So my prediction, I think we're going to see quite a bit of interest rate hikes over, the first part of this year. I think they're going to aggressively attack inflation with interest rate hikes, but that will probably slow down quickly. I think there is an element of transitory inflation from last year, just a lot of bottlenecks and in the supply chain driving, increased prices that have flowed through. Same thing with energy, but whether that becomes sustained and part of the mentality, and whether producers are maintaining high prices, and whether wage earners demand higher wages, and all of that continues to perpetuate inflation is the question. Whether it kind of gets ingrained in the psyche or not, and the uncertainty around the war, who knows what could create a downdraft, right, and stop all of this. if they get too aggressive on inflation rates or interest rates, I'm sorry, we could see things quickly turn around in the other direction, especially with as much debt overhang as the country has at this point. A lot there on my crystal wall, I guess.
Yeah, I mean, I think those are all good points. I think that, I share a similar point of view on interest rates. I think that, if you look at the curves, the rate curves, things are definitely going up, and we're expecting to go up. We're starting to see hikes. We've heard the Fed say they may hike as many as 6 times over the next year and a half. They may hike at 50 basis point intervals versus 25.
Mm-hmm.
But I also think that it is relatively short term, because I think the first lever they pull as the economy starts to slow down is to pull back on interest rates.
Right.
And so I think that, over the next couple of years, we will see those rates go up. And I think it's important when you think about it from a debt perspective, what kind of debt are you using? Right. Because I mean, that's the number one thing that's going to be affected by your interest rate. How long are you fixing it in? Are you fixing it in? Are you floating? Are you buying a cap? And kind of these different instruments. I mean, all of these different debt instruments, I think they're just different tools, and you got to use the right tool for the right project, and I guess at the right time. And so I think that's where you reduce a lot of your risk in these investments, is in the type of debt that you're choosing, and the timeframes that you're choosing, and if you're fixing or floating, and how you're protecting yourself with caps and other things. And so I think that's something to really focus in on in investments,
in your underwriting as well, right?
Making. Yeah. I think in the underwriting also, as you're evaluating other deals, just asking those questions around debt, I think are going to be one of the most important things over the next couple of years.
Absolutely. And they always should be, right? You always want to know what their debt strategy is, whether, some firms have a floating rate policy. They like the floating rate loans. Some people like fixed rate loans, and you want to understand at least the sponsor's strategy around that, and how they employ it, and protect against the downside of each of those strategies.
Yeah, definitely. So, there's kind of made a comment here around new investors and operators in the market, and maybe some big mistakes that you're seeing. Perhaps it's as you're evaluating your own deals or from other points of contact, but maybe share some of that. Why do you think that's happening? What are some of the things where you see people going wrong?
Sure.
And so folks can maybe have the same perspective or avoid some of these things.
Yeah, where I see the biggest mistakes these days over the last 3 to 4 years, as competition has increased. So we talked about this earlier. There's a lot of people getting into real estate, a lot of new investors, a lot of new sponsors. So there's a lot of capital. There's a lot of people chasing deals. We've seen cap rates go down and down and down, right? I don't know if they can get any lower at this point, especially with interest rates going up. And so what happens when you're a new investor or a new sponsor and you want to buy a property? You got to outbid everybody else that's trying to buy that property, right? Especially people who have been in the business for 20 or 30 years and have closing power. They've got broker relationships. When they approach a seller, the seller knows that they're going to close, right? They know they have the money. They know they have the track record. So a new investor is going to have to pay more, most likely, in order to win that deal. And so what I see happening is new investor underwrites a property more aggressively than an experienced sponsor. And they're willing to pay more because they have underwriting that says, rents are going to go up 10% for 5 years or whatever. And that may be realistic for this year, which is an anomaly, but that's probably not going to work for 5 years, right? So, and that's an extreme example. I don't see that very often, but that's the point I'm trying to make, is that usually it's driven by unrealistic underwriting expectations, and that they can either increase rents faster than anyone else or decrease expenses to an unreasonable level that's maybe not achievable, or they're not investing enough in the units, upfront to increase the rents. Maybe they underestimate taxes, because when you buy a property for more than the last guy, those taxes are going to go up, and quite a bit. And we're also seeing just tax rates go up on properties. So oftentimes the tax implication of a purchase are underestimated. So those are some of the examples that I see young sponsors making. And I think that's exacerbated today, especially with, the low rates, being able to put even more debt on. There's competition from the debt side as well, right? So you may get more leverage than you really should have on a property. And that's where you start to get into risky situations. When you've underwritten a property aggressively, you've over leveraged it a little bit. And what happens when the market changes, or maybe you've got short-term financing that you need to refinance in 2 years, bridge loan or something. Those things I'm seeing much more often these days. Lots of bridge loans that need to be refinanced in 2-3 years, and who knows what's going to happen at that time. So all of those things are mistakes that I see made by new sponsors, and it's not a mistake if it works, but it's a potential, red flag there.
Sure. So it sounds like in general, just overestimating on your underwriting, maybe taking on too much leverage. How much leverage do you see folks typically in the deals you're looking at? How much leverage do you see folks taking on? Because there's still that debt service coverage component that's going to limit the amount of leverage you're allowed to take. So where are you seeing that fall in now? Because most deals I see, really it hits debt service coverage before it actually hits any leverage thresholds. That's really what's been limiting the amount of debt you can put on deals.
Yeah. So what I've been seeing a lot lately, are you asking what is the debt service percentage that I've seen on properties? Because it varies by, type of asset and that sort of thing, and sponsor. Some sponsors.
Yeah, I'm asking more what type of, you just mentioned that one of the risks is being over leveraged. So I guess I'm asking kind of what is your definition of over leveraged, and
gotcha.
What do folks look out for?
I think when you're getting above like 75, 80% is pretty leveraged on a property, right? You don't see that very often, but 70 to 75 is pretty typical. I see the more experienced operators more, especially in mobile home parks and self-storage, down around like 60 to 70. And a lot of these experienced operators will cap their leverage at 65 or 75%, no more than that. So somewhere in that like 60 to 70 seems to be the more experienced level, where they're taking a little bit more equity, putting a little bit more of that at risk, as opposed to more debt and leverage. The other area that I see a lot these days is this multi-tiered equity structure that is debt plus almost like a mezzanine debt kind of equity. That's like this 10%, low participation in the upside, but it's almost like mezzanine debt that's unsecured, right? So you've got 75% leverage and you've got 10% mezzanine kind of debt at paying 10%. And then you've got this equity stack above that. It's like, that is a bit over leveraged in my opinion. So it's not exactly debt, it's not leverage, right? But it's sort of this hybrid. And then of course you have bridge loans.
Equity.
It is, well, preferred equity has different, you can do different things. So you can have a pref with a higher split with the sponsors and investors. And what I was talking about is a pref that's a higher preferred return, but a lower split.
Gotcha. Okay.
Which is almost like a note, right?
Yeah. And I think we're definitely seeing kind of some interesting models out there. And I agree. I think leverage is something to look out for. I guess as folks move to more bridge loans and are able to get higher leverage, the thing to look out for is, what's the time frame? What's their exit plan? How does the time frame, how does the term of the loan align with their exit plan? Right. I think one thing that we try to do in our deals is look for, at least a cushion of a year outside of our, from our exit plan. We want to have an additional amount of time beyond what we think it's going to take, in case it, things just don't work out for whatever reason. Because things always run into, you always run into
absolutely.
issues.
Yes.
Manage through that.
with around the bridge loans, you're talking my language here, because you'll see a 1 year or 2 year loan with no options, no option year extensions.
Mhm.
And those are particularly risky, especially when you don't know where the market's going to be in 2 years. And if you happen to have an issue with the property that you purchased as far as renovating it, or maybe the market goes down and you can't raise rents,
Yeah.
now you've got a situation where you need to refinance, and maybe you can't. Maybe you don't have the income to support a refinance.
Right.
So
Yeah, I think that's like
you're right on there.
to me, that's more important than even where, like in the shorter term, I mean, outside of a cataclysmic event, right? Outside of us getting into a worldwide war, I think we can be pretty clear on where markets, for the most part, will be over the next couple of years. The further out it becomes murkier, but over the next year or so, I think we know pretty well. I think what to me is more risky than where the market's going to be is, can you execute your business plan in that time? Because to your point, you have to have the income to be able to get out, to be able to refinance in a way that you're not having to put more money in at that refinance period. And so it's like, the way I look at it is, when can we realistically implement our business plan? And from there, let's put a little cushion on the back
Right.
end. Right.
Right.
And so it's about execution, the ability to execute, I think, to be able to get that income, to be able to then refinance in a way that's going to allow you to actually take cash out versus having to put additional cash in.
Right.
Because you can't get the leverage that you're
Right.
looking for, right, on that next loan. And I think that's one of the biggest risks people should be looking for is.
Well, and that gets to my
ability to
point
execute.
of the sponsors that have long track records and have been around for a long time. They have a history of executing well on their projects. Most of these guys, they've got, contractor relationships. They may have their own in-house, that sort of thing. A lot of the new investors or a lot of new sponsors may not have those deep relationships or a backup contractor or whatever to execute per plan. And so even though it may be underwritten in a achievable manner, maybe they don't have the relationships or the team to drive that performance at the project level. So again, that's another reason why I think the sponsor and asking the sponsor's track record, especially on execution, like you just said, in order to achieve that refinance, you got to execute. And so seeing what they've done in the past and having that track record is important.
Yeah, absolutely. Track record is important. I think everybody has to start somewhere, though. So I don't think I'm quite as heavy-handed as you are when it comes to track record and positioning. But I think it's important to show. I think it's important for people to be able to relate whatever success that they've had in their life to how that's going to make them successful in real estate. And then I think as you develop a track record, which can come pretty quickly, I think it's important to have one, to be able to communicate that, and two, to be able to show those proof points, right? And I think that yes, the companies that have been around forever and should have those things in place. They can operate in some ways better than some of the smaller ones. But honestly, on other times, I see larger firms that have become kind of the big corporations and more layers and more bureaucratic can be slower to move on opportunities and can have more layers and more friction on execution. So really, I think to me, it's a balance, right? If you have some executors who are really nimble and can get really creative and don't have all the policies in place to the point where they can do what needs to be done, not kind of be boxed in. I think there's value there too. So
I agree with that. I believe that
sides.
there is a place in your portfolio for, those investments, but you need to weigh them against, more safer investments as well. So
Sure.
That's the diversification play. I focus my investing and my funds on, this long-term foundational investment with companies that have been around for a long time that, have proven track record. And then of course we invest in other things that are more risky and should produce a higher return, right? But that's all part of an allocation strategy specific to what I do, right?
Yeah. No, I think, and obviously that diversification is so important. So, Mark, as we're winding things down here, I wanted to ask you, you've been in real estate, your wife's family's been in real estate for a long time. You guys have done a lot of different things. You made a lot of investments. What are some of the mistakes that you've personally made that you've learned from, and how can people avoid those?
Well, I think we've talked around a lot of them. A lot of what I discussed earlier, it comes from lessons learned. So things like being too aggressive, like a moth to a flame of chasing the next trend. When I originally got interested in real estate, we really went down the path of becoming an active syndicator, not realizing how much time and effort that took you're creating your own job, right? You're not doing this on the side. It takes dedication to really be a successful hands-on operator, if that's what you're trying to do. And so we did that with a number of partners in the mobile home park space. We executed well, but realized ultimately that it was more than what we could handle as professionals. And so, we're winding that down, but that was one lesson, right? Don't bite off kind of more than you can chew, and go in with your eyes wide open. I have seen some aggressive underwriting. I've been on some underwriting that we were too aggressive and had expectations of markets that did not turn the way that we expected them to, or we weren't able to raise rates. We weren't able to, turn over the clientele as quickly as we wanted to and thought we could. They didn't turn into big portfolio killers or anything like that, but we didn't lose money. However, they didn't perform as well as we expected. So a lot of those mistakes that I talked about earlier, I've seen in my own, experience at this point.
Gotcha. Well, no, those are great lessons to take away. I think those are great, as well as the ones you mentioned earlier. So, want to take you through our keys to success round. We've got 4 questions that I like to ask you. The first one is, if you were going to invest money with somebody else and you could only ask them one question, what was that? What is the one question you'd ask?
I would definitely ask, what's your track record, right? I believe that 80% of your returns, can be predicted by the track record. It's the 80-20 rule that you always hear. And if you hit on that, what's your track record and experience, you can follow up with the other 20% and weed out most of the riffraff right up front, and then get into the underwriting of their models and their, financials, and all of that sort of thing can come later, in my opinion. Especially if you're just making a foundational investment that's like diversification from your 401k, right? I'm just venturing in to real estate. I want to make, a comparatively safe investment. Focus on track record first. You can come back to the other 20% later when you get some experience. That would be what I would ask.
And that's a great point. I think you're hitting on one of the kind of key foundations of what we talk about a lot on this podcast, which is really, it starts with the sponsor first, right? I mean, it really is all about the sponsor. And so you're understanding the sponsor before you're understanding the deal, right? You're vetting the sponsor before you're vetting the deal. And I think that's right on. So Mark, what are you most proud of in your career?
Well, I'm very proud of my role as the CFO of Cogent Security, which is the firm that, like I said earlier, I was consulting for, and ultimately turning that into a partnership with, the founder and becoming the CFO. Very proud of that. Also very proud of my wife and recognizing the opportunity to get into real estate investing, opening my eyes, and then really just taking the steps to pivot multiple times to figure out how it best fit for our needs. And so we're definitely feeling comfortable with where we are now. And I'm very proud of that in, developing these funds for people like ourselves.
Yeah, that's fantastic. What is a book that everybody should read?
So Private Equity Real Estate, PERE by Sean Cook, I think is a very foundational book for busy professionals that want to venture into some of this. I think it's called Private Equity Real Estate Investing, something like that. I can give you the link exactly. That's one. Scaling Up. I got a bunch of books back here on my shelf that I go through, but that's another one. Traction. Sorry, gave you 3.
No, those are good. I actually have not heard of that first one. Private Equity Real Estate Investing. I'll have to check that out.
Sean Cook. I know that's the pseudonym that he uses.
Yeah. Well, we will put the links to all those in the show notes so people can access them easily. And Mark, last but not least, what is your number one key to success?
So it's finding time to focus. It's time management and really blocking off my time. So as a busy professional, you've got multiple things coming at you all the time. Things come up, payroll has to be run. Somebody's got a question about their benefits, all of those things happen. But you have to be able to block your time to focus on, key things and knock them out, right? Mm-hmm. Make lists, tell yourself when you're going to do X, Y, Z in that block of time and do it, turn off your notifications if you need to. That's been my key to success is, focus and time management and blocking.
Yeah, no, I think that's awesome. I think I'm a huge proponent of blocking time, getting into some deep work, really putting, hours of focus, into one thing and getting it done versus scattering across many. I think you'll find it be so much more productive. So,
and you just mentioned another book, Deep Work by, I think it's Cam Newton or Cal Newton.
Yes, Deep Work. That is a great book. I can't remember the author's name either, but we'll link it in the notes so everybody has that, because that is another great one, and I follow a lot of those principles.
Yeah, excellent.
Yeah. Well, very good, Mark. Well, thank you so much for coming on the show and providing value. If folks want to be able to get a hold of you, they want to learn more about what you're doing, how can they reach you?
Sure, they can reach out to me through ciracapitalgroup.com. That's CIRA capitalgroup.com. And you can just go to our website. There's a contact us page. We're launching a fund right now that's foundational. Like I said, just all of the things I've talked about, maximum diversification with some sponsors that have been around for a long time. And we'll have something like more than 40 assets in that fund between 2 sponsors with lots of track record.
Gotcha. Well, very good. Well, we'll include that as well, so folks can reach you on the website. And with that, Mark, I hope you have a great rest of the day.
Excellent. Thanks, Ken. Happy